The Business Innovation Zone, also known as the Biz, is the place to start for entrepreneurs in Iowa. The Biz helps entrepreneurs and startup companies focus on idea development, business models, strategy, market validation, mentoring, and networking. We also help clients connect with qualified community and state resources needed to grow their business. Throughout the year, we provide a number of networking opportunities with experienced entrepreneurs and business leaders by offering monthly luncheons and all-day seminars on marketing and finance. You can learn more about the Biz at bizci.org.
Welcome to both of you, and thank you for coming. I want to ask the first question, and I'd just like you to both take a minute or two. We've got 2013 coming. There's a lot going on in the political, economic world, but it seems Midwest is a little bit insulated from some of that. What are each of your views on raising capital, both at the angel and the VC level, going into 2013? And if I could, Matt, if you would start first.
I think the public markets have an impact just because of overall mentality. There's funds out there with capital that are going to invest no matter what. But if you think of this last 3 months, the IPO market's largely been closed, and venture firms that have a whole stable of deals and can't get any of them out, or maybe they're selling a deal here and there but haven't had an IPO for 2 or 3 years, it does have an impact on their pace of investment. But overall, I'm optimistic. I think the cliff's got to get solved. I think the markets, I hope it gets solved in December, because I think the market will really take off in January, and it'll be a great start. So that's my quick opinion. I think there's a lot of people, plus everyone, if their 401k is doing better, it's a little easier to write that check to invest 25 or 50 or 100,000 at the angel level as well. I think it has a positive impact, a good overall public market.
Yeah, I think I would agree. I think the uncertainty, hopefully we're going to get past the cliff and deal with all those issues. I do think also there's a lot of money on the sidelines. There's also a lot of high net worth individuals out there that, because of maybe the roller coaster of the markets, are looking for alternative opportunities to invest capital as well. And so I do think we might have a little bit of a short-term holdback here with regard to the fiscal cliff. And if anybody in Washington could ever get anything done, I think the signs in the capital markets will improve. And I definitely think there's a lot of money on the sidelines. And I'm a true believer of good quality deals can be funded.
Thank you. There's forms on just if you're not feeling like just raising your hand, you're welcome to write them up and just hold them up and I'll come and get them. One of the questions from the audience was looking at the idea of angel or venture funding versus the idea of crowdsourced funding, and what you both think of the crowdsourced change or addition to the world.
Go ahead.
I'm no expert on crowdsourced funding. I don't think it's, the nice thing is we've probably got more attorneys in here than anything else probably today that can complement it. I don't know all the end results yet, and I understand it's still under SEC review. It is. And so I'm no expert on it. I think there's a lot of issues that got to get resolved with it. I think there's some dangers to it as well. So I really couldn't necessarily provide a lot of comment on that. I do think no matter what it is, whether it's crowdsourced or you're going through an angel or VC, and hopefully we'll get into some of these things, it's still, having a compelling idea, a business plan that you can articulate, a proven model, and obviously something that is hopefully not a commoditized type of product in the marketplace. If it is, how you differentiate yourself. So, but crowdsourced funding, I'm no expert on.
Yeah, I'm a fan of crowdsourced funding. I actually participated in a deal. The Pebble watch. Anyone else buy a Pebble watch? This Mike and I. Okay, I'm surprised. This is a company. They started a little digital watch that connected to your iPhone or your iPad or any of your Apple activities, synced up. And I don't remember what the prices were, but it was really an interesting model, I thought. I mean, they had something like 60,000 followers or interested parties. And literally, I can't remember what, $125, I think, and you bought a watch, you got a couple other things, and they built a prototype, but that was it, a prototype. And they've spent the last 6 or 9 months trying to get the watch built in China. Yep. But they have, they raised, what, $10 million, Mike? $8 million?
Yeah, it was over $10 million.
Yeah, $10 million in 60 or 90 days.
And none of it's equity.
Yeah, that's right. It's all pre-sales, effectively.
It's just sales.
So for certain products, like a consumer product, every now and then I'll see someone with a consumer product. I think it's a great tool. We don't invest in a lot of companies in that space, so we haven't used it. but I think it's really interesting. Now, the whole idea of selling equity, I'm a little more leery about. I mean, I get excited about the idea of, if you think 15 years ago, there used to be a lot of little public deals. They'd raise $5 to $10 million. You just don't see that anymore. An IPO, you have to have a company that's going to raise $75 or $100 million, or Goldman Sachs, Morgan Stanley, they're not going to touch it, right? And it's really hard to raise a $10 million deal in today's environment. So you look at the Pebble Watch. I mean, they were able to raise $10 million and not sell any equity and go out and give it a shot. Now, whether the watch is going to work, who knows, right? I mean, that's a little risk we all took to see if the product worked. But I think it's exciting. You know, selling equity again, it'll be interesting to see how that works.
Yeah, just to add on, when I talk to people about it, I think the thing you have to think about with crowdsourcing is it's a wonderful way to validate a market. So if you take Pebble Watch, they went from an idea and a concept to probably somewhere north of 9 million actual cash in the bank and thousands and thousands of prepaid customers. So that's, now if you needed to raise real money, if you will, that's a lot of market validation to go to somebody and say, I still have 100% equity, I've got all this cash in the bank, I have all these orders, but I need a strategic partner to do the manufacturing. So, questions? Tage.
So the question will later be asked, I'm sure the question will be asked, what should the people raising money in this community do right? My question's the reverse of that. What should the people raising money in our community locally quit doing?
I like that question.
Quit doing?
Yeah, what should they quit doing?
Well, I'll probably have a different angle than Matt on this. A lot of times when people come to my office, they've been, you know, theoretically out raising money, but they haven't been raising money. They've been having hypothetical conversations about, you know, if I did this, would you invest, and prolonging a process versus really maybe sharpening the focus and the execution of how much they need and what valuations they're looking for, and really trying to get some terms across. It seems like they're out there a little early and having a lot of different conversations. So, you know, you hear the term overshopped, but a lot of times that happens in that somebody will have an idea or concept and just start out there before they're truly ready to get across the table from somebody or an investor. They're just out there, you know, maybe with having different versions of business plans or pro forma financial statements and just different types of conversations. We deal with that daily with people that come to our office because they've been out and had so many iterations. So one of the things we would definitely recommend is just take the time to really work through your plan, through your financial model, try to determine how much capital you need, your execution strategies, your team, et cetera, and be diligent about it, and then begin the fundraising process.
Go ahead.
Yeah.
I think Matt had a comment on the last question.
I was just going to say that one thing I've noticed in the last 10 years, you know, we used to get a lot of plans that were a raw startup, just a business plan, needed $3 to $4 million to launch. And I almost laugh when I see those plans today. I mean, we used to see those all the time 10, 15 years ago, but now you've really got to get traction. You know, in different businesses, sometimes you can't do that. If you're going to build a hospital, you can't do that, right? But if software business, how do you get traction? How do you get proof of principle? And I mean, focus on that. Get some momentum. If you get some momentum, if a company gets momentum, it's much easier to get on the radar screen. And that's the one thing I still see from local entrepreneurs once in a while is kind of well, here's what we want to do. We want to leave our corporate job, but we need $3 million in the bank to do it. There's not a chance that we'll ever fund that deal. I mean, just unless, by the way, somebody we happen to know or had success with, then we would consider funding that deal. But just a raw startup, we used to see it all the time, and I see it a lot less now, but we still see it once in a while. So that's one thing. I mean, if you're going to start a company, go after it and start to get traction. Go ahead.
I heard this guy interviewed on it was a television show called Charlie Rose. I don't know if anybody's heard of it. He's like a CEO of a company, Cisco. Does anybody know that?
John Chambers.
John Chambers was interviewed, and he basically was talking about that at his level, unless they have a new product in the line every 6 months, they're going to be left behind at that level. I mean, those of us here in Des Moines are a little perhaps verklempt, or we're cautious, but where is the connect between that speed of innovation which is happening up at the highest levels of, you know, business, and then what we're doing here, what is the connection? When you have people that are saying, well, we're out of the loop if we don't have a new product in line in 6 months.
Well, I think it's a big positive for an earlier stage company, because there are companies like Cisco or other big players that are out there, and, you know, do they build it themselves or do they go acquire it? Usually they acquire it. If you look at the pharmaceutical industry, the biotech industry, you know, Merck, Pfizer, they used to have these huge R&D departments, and they still have big R&D departments, but now it's pretty clear their strategy over the last 10 years has shifted from let's build it ourselves to let's see who gets real traction, then we'll go pay $300 million to $600 million for a company when that's starting phase 3, and we'll go from there. Or Cisco, and I don't know, Cisco, Christian can comment, Cisco used to do so many acquisitions, acquiring products, and the question really was how did it fit with their sales force and their overall product fit. Right. But I think it's a real positive for smaller companies. It's tough to get on the radar screen of a Cisco, but there's all kinds of companies out there that are building through acquisition and fitting it into their existing portfolio.
When companies are anxious to raise early stage rounds, what are the common pitfalls they may hit that could hinder getting their later stage round?
Well, execution, you know, and you know, Matt hit it right on the head even when you get the initial capitalization, or you're trying to get the initial capitalization, it's all about market validation as well. You know, prove that you have the ability to extrapolate, you know, the customer relationships that you currently have, and how additional funding can get you to further growth with the customers you've got, or the market, or distribution agreements, or whatever. But to answer your question, if you've been funded and then you trip up, or you're going through a process to try to raise additional funding, it's all in the execution. And to come back to the prior point, I think exactly to that point and Matt hit it as well, the big corporations aren't as nimble, and they don't have the ability to maybe to pivot as an early stage company. But early stage companies need to focus on what they do well and execute upon what they do well, and pick that segment that they're going after and execute. We also see a lot of people that have that type of a business plan that they're going to be everything to everybody, and I think that's a big challenge as well. You know, pick the market segment you're going into, pick the product set you're going to be delivering, and go about it and execute. So a lot of times we'll deal with clients that have had an early stage round and have tripped up. Sometimes it's economic issues, sometimes it's, you know, pure external issues, and there's reasons, but as long as they've got a plan and are creative about how they adapt to that, there's still opportunities for additional capital.
For entrepreneurs, what would you advise them if they're out talking to potential investors but they're not getting investment? How do they know that they just need to be persistent versus they need to go back and look at their business plan and their business model and make some revisions?
Well, that just comes with the experience. You know, if they're out and they pitch 50 people and they get 50 no's, I mean, hopefully they're asking for direct feedback, and some people won't give them the direct feedback, but hopefully they get some. Maybe it's a management issue. You know, maybe it's a market issue or a plan issue, but, you know, oftentimes, even with some of our best executives, we'll be going down a path, and then it's not working for one reason or another. You know, we take a left turn, and sometimes we call it quits and hand it up, but usually it's, okay, this isn't working, but how can we make it work? And so that's more on the business side, but really the same for fundraising. We've changed strategies in fundraising before. We've been out and we tried to raise $50 million for this deal with large institutions, and it just wasn't getting the traction we needed. So we changed the plan, raised $10 million from a different group of investors to continue to move the company forward. And if you get progress in the company or momentum in the company, it's attractive. I mean, if you don't have growth, you know, then there's an issue, whether or not you can raise capital, and time really works against you. You know, if you don't have growth and you're out there 1, 2, 3, or 4 years, I mean, first question I say is, what have you done for 4 years? And maybe you're building the product, but that's again why I don't see a lot. Well, we're gonna start today and we're gonna launch our product in 2 years. I just don't see that anymore, or not many plans funded like that anymore.
Yeah, I think sometimes no is the most important answer you can get when you're raising capital, because you need to listen for the market feedback and adapt. Like Matt said, I mean, there might be changing strategies. If you've gone through a process and have 50 no's, it is really, you know, you've got to inquire, and you've got to try to get feedback. We always tell all of our clients, listen to the investors. and listen to their feedback and ask for feedback. A lot of times people don't want to tell, particularly when it's individual investors, they don't want to tell them no. So they'll say, maybe, or they'll prolong it, or they'll be nice to them, and don't want to hurt feelings. We'd rather have feelings hurt, or we'd rather have, really candid responses back, no, but, and try to understand what those issues truly are and try to learn from it.
I have another question. I heard it, if I may. I heard a joke the other day in a locker room. This is a true joke. I overheard some guy saying, well, who's going to be the next Warren Buffett? And the guy said to the other guy, he said, I heard that she's going to graduate school in Beijing, China. The joke being, of course, that the money decisions of the future are happening in China. How does this affect all of our consciousness and our business model?
What you handle.
China's a big market. We don't really work in that market. We've looked at a couple deals over there and just can't get comfortable. And it's primarily because we don't have a partner that we really trust over there. So I don't disagree. I mean, that market is such a monster market. I still think the U.S. is, the money center in technology. But I'd say we're slipping, right? I mean, I think China is really coming on strong. And I don't know. I mean, I don't have a lot of insight to that market.
So I want to go back and follow up on the what are they doing wrong, 50 no's kind of question. And have you both addressed something that I think we all see a lot of is the idea of a product versus a company. And if you could speak to, I know JD, we were just having a talk about a product versus company issue. If you could just speak to, from a raising capital standpoint, the importance of a company versus a product.
Well, I mean, obviously, it's if you even have a great product and no one's buying it, you really don't have a company. I mean, that's the fundamental. And again, we talk a lot about market validation, but the most important thing to build, if you've got a great product and no one's buying it, you have issues. And so it's adapting to whatever that product is or those services, which services are a product as well. And validating that you have purchasers out there, you have customers out there, you have distribution agreements out there. That's how companies are built around a product. And I'm sure Matt sees a lot more than we do, but it's a lot of times the product is the concept and the company is the execution, and they go hand in hand. And you've got to have that. If you've got a great idea and a great concept, but you don't even know your market, or you can't understand your market, or how you're going to penetrate your market, you're going to have a very difficult time raising funds, but also just growing a company.
Yeah, I see a lot of one-off products that aren't companies. We work in this space. It's molecular diagnostics for high-end healthcare applications. Oftentimes, I see very bright people, PhDs from Harvard in a very specific science area, and they literally think, well, if I get this test developed, it's such a great test, everyone's going to use it, and they don't have a clue, to try to distribute that in the U.S. into whether it's hospitals or to the physicians, to get the prescriptions, to get the use of it, the referrals to it. It's a totally different skill set. So, like in that company, we have a company in that space, and we're often looking for products that maybe they've raised $40 million developing it, and they've tried to launch it, and they fell flat in their face. And they can't raise another penny, and we can go in and buy that on the cheap, because hopefully our team can execute and launch that product. But I see that often, and it's a skill set around the table is a lot of times the case.
Couple questions, guys. One, what areas of the market do you find attractive, U.S.-wide? Sub-question to that would be, what areas of the marketplace would you find attractive, do you think, for Iowa? And then a question on tech transfer. What do you think we need to be doing, or perhaps what are we doing right, what are we not doing with respect to our tech transfer, and specifically with respect to the Regents universities?
You handle the tech transfer?
Sure. I'll address tech transfer first. I've been involved a little bit at the University of Iowa, and I've worked with Iowa State on tech transfer. And there's successful models out there. MIT and Stanford are examples that just crank the companies out. Now they have a unique talent pool as well. I'm not saying they don't, but I think their models on the way to incentivize professors or other people involved to start companies, and it doesn't really hurt them. I mean, we have a ways to go there, and I think we're making progress. I think it's come a long ways, and the incentive and the support of the faculty to rollout companies or developed technologies is getting better. But we're still, we're not even to first base, and there's a lot of people that are going around for the second time on the home run. It's just, we have ways to go there. And an example, we worked on a deal, and I won't name the university, but in the end, we tried to give the professor equity in the company, and their research group really dissuaded them from not taking any equity. And I understand conflict issues, but these are the issues we need to work through to get them equity so they can really help. And quite frankly, and we had the lip service from the professor that he's still going to be involved. He's been nowhere, and which has really frustrated us as investors.
J.D., did you want to take the question on what's interesting in the market right now?
Yeah, I mean, you asked Iowa, and then, obviously, web-based services, software companies, I think they can be built anywhere. Obviously, Iowa, there's a lot of, clean technologies, renewable energies, and then the ag market is still, there's a lot of growth opportunities there. So I don't think anything necessarily, I don't think there's barriers with regard to geography. I think that Matt would answer probably a lot on the healthcare side, because they've done a lot on the healthcare sector, and that obviously continue to grow. We're not getting any younger as a populace, so I assume that there's going to continue to be great opportunities there in the healthcare sector.
Brian, you had a question.
Within the angel groups that you associate with and the circles you run in, when you see the deals that have come across in the last year, particularly in the software space, what types of multiples or returns have you seen that have gotten the angels excited enough? And forget maybe it's a passion play for them, and maybe it's something they care a little bit about, but the return is what gets them excited. What can you share, just some numbers, generally speaking, of what you've seen come across in the last year?
Are you talking about forecasted returns?
Yeah. Forecasted.
Yeah, and again, that's all back to the way to extrapolate returns is taking a company that's already doing something, already has customers that you can understand what they're going to do with this funding and how they're going to grow, versus just a pre-revenue company, which is very, very difficult. For us, we normally like to do what we call an IRR calculation based upon the assumptions of the forecast over a 5-year period. A lot of times we'll beat that up, and then we'll cut it in half, if you will, and even still kind of come back to it. But I would think that they need to glean between well above at least 25% is where we at least try to start that target at. Matt can talk from their investment side of what they look for as far as returns. But the ones that have funded also kind of have more proven ability to hit to those returns and are already out there in the marketplace versus pre-revenue. So.
Yeah, we look at, and part of this is a function of John, and he's 84 years old, so he's not in it for a 20% return, right? We're looking at grand slam deals, or we're not going to do it. And a lot of those fall flat in your face. You're taking more risk, but we're looking at a deal. Can we invest $500,000 or $1 million and make 10, 20, 30? Right, that's kind of what so it's got to be a big enough size company. It's just but some of that's different. That's not probably typical for any kind of fund or a typical office. It's more the action, right? It's the love of the game.
So for the small startup that's looking to raise their first real capital from outside of friends and family, if they've got the things in place, if they've got a little bit of decent business plan, financials, a little bit of traction, how much time should they expect to spend closing $400,000 to $800,000 of equity raise, realistically?
6 months.
6 months?
That's what I was going to say, 6 months.
Yeah, okay.
Yeah. That's a mistake a lot of entrepreneurs make, by the way. They think they're going to get to a stage, a milestone, and then be able to raise money in 30 or 60 days. And they've got to, and then we always go through this. You look at the different milestones. When do you need to raise more capital? And you need to have a lot of runway.
Yeah, so let's say I need capital by or let's say by March of next year. When should I have started to talk to investors?
Well, my opinion, if you got a company in a certain space, it's almost never too early to talk to what I call target investors. Okay. Maybe it's too early for, let's say, a fund or a certain investor, but even if it's a year before you're potentially going to raise money, if you get an introduction, have a good meeting, and tell the story, and then you execute on that, the probability that they're going to have an interest a year later goes way up, as opposed to a deal that they're seeing for the first time a year later and didn't have the benefit. Now, the downside of that is if you fall flat in your face, or you're a third of your revenue projection, it doesn't help your case. So that's. That's the issue.
I think that's a really important point he's making there too, is because you're having the general introduction. You're not asking for the investment today. You're laying the concept down, and then to Matt's point, you're going to execute, and versus being in front of somebody trying to raise the money for the first time when you may not be ready.
Follow-on question. What we see a lot of is people coming in saying, I'm going to raise half or $1 million now, and then in a year I'll need another $3 million or $4 million. Do you guys prefer to see that structured as one round, or do you prefer to see them structured with gates and funding based on milestones and so forth? Would you rather do that transaction all at once with them, or would you rather see them break it up into separate rounds for whatever structural reasons?
I think 12 months is really the shortest period of time. You know, every now and then we'll see a deal, and there's basically they're trying to raise enough money for 6 to 9 months of runaway, and that's just not enough. unless the exception is maybe like an FDA milestone. You know, if you're going to get FDA approval, because then it's generally easier, or a failure, and the company's going to go kaput, right? So, but usually I like to see at least 12 months, more like 18 months. But in your case, you know, a 500,000 to $1 million. And then 3 to 4, I think that is 2 rounds. You know, and it's milestone. What can you show you've accomplished to increase the value before you hit that $3 or $4 million next round?
I couldn't agree more. In other words, it's less dilutive that second round, right? You've gone out, you've executed, you've increased the enterprise value of your company, and then you're back out. So it's getting to whatever those major milestones are. You know, whether it's customer levels, revenue levels, earnings levels. And then wherever that second growth spurt comes from, going out and getting, and it's usually a different type of investor anyway versus the person that would be in the $5 to $1 million range.
You want the guy with his eyes off the business, or the guy, gal, executive, with their eyes off the business for another 6 to 9 months to go raise that second round after the first round money? I mean, because they're going to be out knocking on doors, right?
You know, I always, you know, the job of a CEO is to hire the right people, to make sure there's enough money in the bank. Right, that's kind of 1 and 2, and then number 3 is, you know, the overall strategy direction. But that's how I think of it. So that's one issue probably with entrepreneurs here. I view the job of the CEO is to raise that money, and if they're so integral to build the business, you know, maybe they need to hire someone else to help raise that money. And it's a pain in the neck. I'm not saying it's not. And if you can raise $5 million, maybe you take more dilution. I mean, I'm not opposed to that. If you can get the money in the bank. We almost always say, hit the bid. If you can get the money, even at a lower valuation, it will help the business if you can get it raised. You know, but to go out for a $5 million round if you don't have much traction in the business is really hard in today's environment.
We had a question from the audience about rate of return, and I guess what I would put it around is an experienced angel level investor first, and then perhaps the VC. What is if they're spreading their risk correctly as an angel investor, what are they expecting for a rate of return realistically?
It's a good question. I mean, I would think to do it, you know, it's got to be north of 20 kind of as a portfolio. Otherwise, I mean, not in today's market, but you could invest in the market and you don't have the headache, right?
Yeah, I mean, I would agree. And you know, some will do, you know, 10 deals and 2 of them will hit and 8 won't, you know, and that's part of it. And they've got the ability and the funds to disperse and manage those risk levels. But yeah, I would think well above 20% on the VC level and probably 30–40% on the return side.
Okay, you're going to go one more question. Oh, Katie, there we go. Good, thank you.
Can I answer one question? I own a staffing agency, and I'm thinking about opening up a separate division. I own a staffing agency, and I'm thinking about opening up a separate division in an area that I really don't know anything about. And I've identified the employee, but he's been burned in a couple previous IT staffing companies and has talked about, well, what about an equity position? I'm not worried about, I can fund it right now out of cash flow out of my current business, but it'd be a separate office, furniture, that kind of thing. What are the pitfalls of going in with a partnership with somebody that knows more about that integral part of it than you do?
I guess my first question to you is why you'd go into a market you don't know anything about. And I think that's your pitfall, right? Because you're relying on somebody that, I mean, I would advise you to make sure you've done your research as well. And if it's a comparable business that you're in or something like that, and you understand it's comparable geography or whatever, and demographics, I think that probably would be okay. But I think you just need to think of the pitfalls are you're reliant on somebody that that maybe you don't have a personal relationship or know, and then second, don't understand the market or some of the challenges in that market.
I don't have anything to add. I think that was accurate.
Sure, thanks. I'm just curious what skills you guys think that are important for a VC to have, and what skills you guys bring every time you go to a meeting, and what has made you successful as a VC?
It varies a lot. I mean, some VC have more of a scientific background if they're focused in that area. In that, if you're in life sciences, for instance, you really need to have a scientific background. Otherwise, it's general business experience, and having seen a lot of deals and worked in a lot of deals, you start to get a sense of what has a reasonable chance of making it and what doesn't. Every now and then, you got to do your homework, right? You got to do the due diligence and make sure the market opportunity is what is expected. See that early traction. Make sure that isn't some one-off. But that's basically it. I mean, it just varies. It's no different than any other business. You do what you can to be good at your business, and a lot of that's people skills. Having ability. For instance, in healthcare services and med tech deals, we have such a strong network of executives and other directors that if we go into a deal, I mean, we went into a deal that the CEO we knew was average from the outset, which is very unusual. But we also knew we could find a replacement, and we did, and it worked out great. And it was a distressed company. It had to be a quick decision. They had a great product, great asset base, but not the right skill set to roll it out. We took a risk that we could find the right people to build that out and take this great asset and try to monetize it. And we were successful in that project. So it's just experience. That's how I do it.
No.
If you can share, have you been part of a down round, and what was that experience like? Was there an opportunity that was presented itself because of that? Were you in on the first side of it? I'm just curious if you were ever part of that, and it's just kind of an open-ended question to share an experience.
You mean part of a down round this month?
Yes.
I knew that was coming.
Yeah.
Or an out round.
Unfortunately, all the deals don't go straight up, and it's just part of the process. Companies don't always work, and the question is, are you throwing good money after bad? Is it there's hope and we can salvage some of this asset, or and for us, money is important, but it's the time resource. Should we continue to spend time on this deal, or should we take our lump, move on, and go do another project? Even some of our best deals, we've had down rounds. We have the saying in our business, being right too early is the same as being wrong. John was in oncology diagnostic business back when I started with him 18 years ago, okay? He was about 10 years too early. That business is worth $1 billion plus today, but they raised a whole bunch of money for it. It just wasn't getting traction in the marketplace. It was right on in terms of the focus. It was just about 10 years too early. And he lost a pile of money on that. Luckily, that's before I got involved. So. Yeah.
Well, first and foremost, thanks to both of you for being here today. Thanks for what you do. I think at least from my perspective, Central Iowa's really tried to take a number of steps to kind of take our entrepreneurial ecosystem to the next level in the last couple of years, and due in large part to a lot of people in this room. But I think we all realize we've got a lot of work yet to do to keep moving in that right direction. What are 2 or 3 things that you think as a region we need to be focusing on to take it to the next level?
I think we're doing a lot of right things, and I think I'll come at it from a little bit of different direction. I think we need to have some successes, and I think that goes a long ways. And so I think it's all about some of the companies out there executing and leveraging off of those successes and then celebrating those successes. I also do think that there's a lot of opportunities with what you guys have done through the Greater Des Moines Partnership and Mike and now Plains Angels, where we are creating this ecosystem, obviously through Startup City as well. So I feel we're doing a lot of right things. Now it's just continuing to support the ones that are out there, helping them grow and getting some successes. I think that'll really help.
I agree with that. A big part of communicating when we have a success. I think of a project we're involved with 10 plus years ago, and there was $5 million invested, roughly, $5, $6 million. and we sold it to a public company. The day the lockup came off, we took all equity. The day the lockup came off, which is really the first day you can sell, it was worth $83 million. And John made some money on it. A lot of people made money on it. The University of Iowa actually made money on it. They wouldn't say a word because they're worried about the State House taking money away from them. I mean, there's a mentality problem. You know, and they had the technology out of the University of Iowa, right? And I'm not blaming Iowa, University of Iowa, but you know, in hindsight, we should have talked about that a lot more. But John used to be a little lower profile. We're chasing deals all over the place, right? We have some successes. We take a lot of lumps. That's part of our business. You know, you got to have a thick stomach lining, and you move on. And you know, so we take the successes. We're happy. We're off chasing the other deals. So you know, but that's. And I think of a software company in Cedar Rapids. I don't know any of the executives, but they sold it for $40, $50 million, and there was not a peep about it, right? And I heard about it through a second source. But those are the kind of deals, you know, one good deal is if I look at John's background, I've had the benefit of looking at his career, his history. He did a healthcare deal in San Diego. That healthcare deal led to 3 other healthcare deals, executives leaving that company, which led, at one time he had 10 healthcare companies in San Diego. You know, so that the network effect is huge, and we need to have a success or 2 or 10 and just build on that network effect. You know, look at the med tech business in Minneapolis. You know, Guidant and the big companies up there. And that's spawned a lot of other companies. So that's right on.
I'm going to ask one question while I get to the other side of the room. Could you guys talk real quick about how you view intellectual property these days versus market traction? There was a time, at least in my background, when a lot of attention was on IP, having the patent, and that's all it's changed a lot with the laws and with the amount of time and effort. Maybe you just speak to that.
Well, I don't probably place as much emphasis maybe on it as others. A lot of times people come and they'll have 3 or 4, 5, 6 patents, and you know, there's people, you know, in other rooms and other geographies or other down the street that probably have ways to get around those patents. It's not to say that protecting your intellectual property is not important, but it certainly hasn't been a hindrance or I'll say even necessarily a help in some of the capitalizations that we've been involved in over the last few years. But you know, from the medical side, I'm sure it's probably a more important process.
I think it is in the medical side. We tend to have more protected IP on our healthcare and medical deals. But you know, software deals, it's not as critical to us, and especially what's going on in that marketplace. I don't even know if I want to have a patent in that marketplace. I mean, it's just crazy. The big companies suing each other and starting to go after the little guys. I don't know. I mean, that's a concern longer term. You know, a bigger concern I think of 10 years ago, you know, I call it the nuclear winter in venture. Back with the 2000 crash, you know, the NASDAQ went from 5,000 down to 1,400, and the 2001 and 2 and 3 were just horrible in the venture business. We always said everyone was, you know, feeding their own flock. Everybody had to put money in their existing deals, and no one was looking at new deals kind of in our environment, and it was so hard. And I thought, and you know, it really thinned the herd in the venture business. You know, it went from I don't know how many venture firms, but it cut a lot. And I thought that'd have a real impact on innovation. But you know, I should have given entrepreneurs more credit. I mean, they figured out a way to do it with less, which is fantastic. It's fantastic. Entrepreneurs, especially software, how do you get traction? How do you build it? Instead of $4 million, use $500,000. I mean, I think it's great for the angel market. It's great for the entrepreneurs. It's great for the industry overall.
If the Iowa Innovation Corp hired you to run their innovation fund, what would you do to make it successful?
Well, you know, there's a lot of press about the fund of funds, and I'm not familiar, not connected to that program. But what I think was incorrect with that program was they didn't require a presence in the state. You know, you tend to invest. We invest anywhere in the U.S., but I added it up one day. We've done more deals in Iowa than I ever thought. And it's because we live here. People tend to invest where they live. And they need to have a requirement. They need to hire a fund manager or multiple fund managers that are based here, in my opinion. And that will have more impact. By the way, I don't think there's any one thing that could probably have as large a positive impact as creation of a fund that is actively investing in this marketplace. I'm not saying every little startup deal is going to get $500,000. If it's doing its job, every little startup deal won't get $500,000. But that will have a positive impact on the environment, in my opinion.
I think that's really well said. I would agree.
Just as a follow-up to that, if you had, or if you knew of people that had $1 million, $500,000 that wanted to invest in Central Iowa but aren't part of the ecosystem and they want to be passive, what funnels exist best today to get some sort of diversified portfolio put together faster rather than slower? And do you think we're doing enough in that area?
It's a good question. You know, now with Plains Angels, it's certainly a good start. When people would come to my office, I would introduce them to other investors, you know, I have 2 or 3 gentlemen that always kind of like to take leads on deals, and others follow and all of that, and so it's just, again, it's creating that networking effect, if you will, and I think Plains Angels is really starting to that, and I think you'll see I think you'll see that network effect continue to expand with an organization like Plains Angels. You know, I'm sure there's direct opportunities to be limited partners in some funds and all of that, but if it's just direct investment that the individuals are looking for, I think it's trying to get them introduced to like individuals that are looking for deals.
Yeah, just to follow up on that one, if I can, there are a lot of people in Plains Angels that are there as 1 or 2 people from a group of investors. Mm-hmm. There's a group of 9 in Urbandale. The 2 youngest guys come to Plains Angels. And when they see something they like, they tell the rest of their team about it. So I think there's a lot of others passively working through it. And I think that's there's no requirement, is all I'm saying, is they don't have to feel like they've got to hook up right there.
We have this one group, you know, again, 5 or 6 of them, but one gentleman they trust on the due diligence side. He leads the thing, leads the negotiations, and then they all, a good portion of the time, they'll co-invest with him. So, I mean, those pockets do exist.
Just a follow-up comment on that, not to make it a big Plains Angels commercial here, but when you've got that kind of a group, and you asked about diversifying, you diversify the expertise that you can piggyback on too. So everybody has kind of a skill set or maybe a silo that they understand really well, and you get in that room and you have 100 people in there, and you may have you have this diverse group of expertise and investment experience, and you can really look at a deal that you think, wow, that's really interesting, but I know nothing about the space. But if you have the right people with the right background and experience, you can kind of piggyback on that and learn. So it's a neat program.
We've got about 5 minutes left for 1 or 2 more questions.
Follow up from an earlier comment you made, Matt, about the regents and tech transfer. Couldn't quite gather, are the regent schools doing a good job in terms of networking and identifying for tech transfer opportunities?
I would say they're doing a better job. I don't know if I'd call it a great job. I wouldn't call it a great job. You know, and again, if you look at Stanford or MIT and look at Wharf in Wisconsin, and Wharf had, was it vitamin C or D? They had 1 or 2 monster hits up there, and they've got like $1.2 billion or $1.5 billion foundation. But they've got, I know, a patent attorney up there, and they've got a staff of people just chasing deals, not just trying to find the deals, but once they find a deal, they've got a staff of people trying to make the right connections. You know, a lot of them are products, not companies. So how do we license this to Merck, or how do we license it to a nutraceuticals company? That's the piece. And I don't know that the Regent universities have really the staffing budget and staffing personnel. I think they're doing some of that, but that's an area that I think room for improvement.
All right, well, gentlemen, I'm going to have to wrap it up. I'm sure if you can stay for a few minutes after fact, I'm sure there'll be more questions, but thank you both for coming and answering all of our questions. Thank you.